for having me. Thank you for putting up all these great speakers we've had today. My name is Ron Ricard, and I'll be talking to you about 1031 exchanges. 1031 is a part of the tax code that allows you to defer taxes. So you're selling a piece of investment real estate, buying a piece of investment real estate, and as long as you do that, you get to defer paying the taxes on the profit that you've made. Important word there though, defer, not eliminate. If I sell a rental house and buy a duplex, later I do another 1031 exchange to sell a duplex to buy a fourplex, and now I'm old and tired and sick of real estate, and I sell that fourplex, you have to pay taxes from the house, the duplex, and the fourplex. You're just deferring the taxes. Now, sometimes I get asked, why bother if I'm going to pay the taxes anyway? There are two reasons we always want to do an exchange. Number one, do you want to pay your taxes today or tomorrow? Tomorrow is the right answer. If the money I don't have to pay the government today, I get to use that to buy more real estate. But the real reason is, when do you really want to pay your taxes? Never is the right answer. And guess what? You don't have to. Because sadly, one day, we're all going to die. And when you die, you win. Well, be honest, when you die, your children win. Because when you die, whoever inherits the property from you gets what's called the step-up in basis. What that means is, all of the taxes you would have paid disappear when you die. So if you bought a property for $100,000 and say it's worth $1 million, and you sell it, you have to pay taxes on $900,000 of profit. But the day you die, your children inherit the property. For them, their basis is $1 million, because that's what the value is the day you die. And if your children are like mine, the day after my funeral, they're selling everything. And when they sell it for $1 million, how much capital gain do they have to pay? Zero! Because they got that step up in basis. That's the real beauty of the 1031. That's why the motto of our industry is swap till you drop. You just keep exchanging and never sell, never pay the taxes. All right. There's a term you often hear in 1031. In fact, if you ever have talked to an accountant or an attorney, they don't call them 1031. They call them like-kind exchanges. That term like-kind is very confusing. Any kind of investment real estate can be exchanged for any other kind of investment real estate. You can sell a rental house and buy a shopping center. You can sell a farm and buy an apartment building. You can sell bare land and buy a commercial building or apartment or houses. You can buy multiple properties, also anywhere in the country. You can sell in California and buy in another state. So it's the 1031 is a federal law. You can go anywhere in the country to do this. It's much more flexible. It's not a house for a house. It's any kind of investment real estate for any other kind. But it does have to be investment real estate. So what kind of real estate is not? What kind of real estate is not investment? Well, where you live, your primary residence is not investment real estate. When you sell your primary residence, you get an automatic exemption. If you're single, you get to keep $250,000 of the profit of the gain tax-free. If you're married, you get to keep $500,000 of the gain tax-free. If your profit is more than that, you pay taxes. Okay? There is no rollover. It's not like I just bought a bigger house. No, that doesn't work anymore. Now, whenever you sell your house, if you're married and your profit is more than $500,000, you have to pay taxes on that excess gain. Now, around here, that's a lot. That's pretty common for our gain to be more than $500,000. Remember, this law passed. These numbers were set back in the tax code in 1997. Now, even back then, that was a lot of money. Not anymore. So we have a lot of clients who are selling a primary residence and they don't want to pay taxes. So what can they do? Well, there are a couple things they can do. Number one, does any part of your property qualify? The gentleman earlier was talking about ADU. Do you rent out that ADU? Do you have a home office? Is there any part of your property that you are already reporting on your tax return? Very important. That you are already reporting on your tax return as a rental property or a business property. Whatever percentage of the property you show as the business portion, that percentage of the sales price you can do an exchange on. The truth is, most of us don't have an ADU. Most of us don't have a home office. So what else can you do? Move out. Turn your house into a rental property. After you've been renting out the house for a couple years, is that house now an investment? Yes. Is it still considered to be a primary residence? Yes. Because the definition of primary residence is a property that you've lived in 2 of the last 5 years. So because of that, if you do this, you can sell the property and take advantage of both tax rules at the same time. So let's say your house is worth $2 million. You bought it for 300, 400, 500, or whatever. It's now worth $2 million, and you're married. You sell it for $2 million. You get to pocket $500,000, and then you do an exchange on the remaining $1.5 million. So it's a way to go. So combine the 1031 with the primary residence exemption. Now, obviously, this does not work for everybody. If you need the money from your house to go buy a bigger house, it's not going to work. But if you have the flexibility and you don't need to sell your house to go live somewhere else, this is a good tax strategy for somebody who has a very highly appreciated primary residence. All right, what other properties don't qualify for 1031? Flipping real estate. This is something a lot of people do, especially when the market is good. They buy a beat up old house, fix it up, and sell it. That's not considered to be investment. Same thing with building a property. You buy a bare piece of land, you build a house on it, and you sell it. You are called a developer. That's not investment real estate. Also, second homes are not investment real estate. Second homes are considered to be properties for personal use. Now, most of you are thinking, that's okay, I don't have a second home. But yes, you do. You know why? Because your children live there, and you're not collecting rent from them. If you have a family member living in a property and they're not being treated like a regular tenant, including collecting market rent, it's not considered to be investment real estate. So typically we think of investment real estate as real estate that you get rental income from, real estate that you run your business from. Bare land is considered investment because it's considered to be held for appreciation. But investment real estate, key here is it is property held for business or investment purpose, not for resale or for personal use. Now, there are a couple of things to know about 1031. The process of the 1031 itself is actually pretty simple. You hire a garage to sell your property. He sells it. Once you're in contract with a buyer for that property, that's when we get involved. We get involved so that at the close of escrow, the money comes to what's called a third-party intermediary. That's what our job is. We are a required part of any 1031 exchange. So the funds come to us. Then you have a very specific amount of time, 45 days. You have 45 days to tell us what you're going to buy. Now you have 180 days to close the escrow, but essentially you need to be in contract on what you want to buy within 45 days from the close of escrow. Once you're in contract to buy the next property, we work with the title company and wire them the money. So you're selling something, you're buying something. Our job is to be what I call the escrow between the escrows. We work with the title company when you're selling. We work with the title company when you're buying. So, but the key here is that you have a very strict time limit. Again, that 45-day clock, these are the fastest 45 days of your life. So I always want to make sure that you are ready for it. Again, you want to be in contract on that property within that timeline. Next thing to know is how much do you need to spend in an exchange? And most people who think about this get the answer wrong. It's very simple though, all of it. Whatever you sell the property for, you need to buy equal or greater to that amount. It's not the profit, it's not the equity, everything. If the property sells for $2 million, you need to go buy something for $2 million. Now, can you buy something for more than $2 million? Yes. Can you buy 2 or 3 or 4 properties that add up to $2 million? Yes. Can you buy less than $2 million? The answer is actually yes, but you pay tax on the difference. So if you sell for $2 million but only buy for $1.8 million, that $200,000, that's sometimes referred to as boot. Boot is what you pay tax on. So you can buy less, and sometimes people want to buy less. That's okay, but you just pay tax on what the difference is. Part 2, all the cash, all the equity that comes from the sale of the property goes to the next property. Any cash that you touch, you pay tax on. So we just had the lenders talk about getting a loan. Don't get too big of a loan, because if you get too big of a loan, you have cash left over, you pay tax. Equal or greater, use all the cash. Obviously, if there was a loan on the property, that loan is going to get paid off when escrow closes. What it means, though, is that you need to get another loan when you buy the next property, or you can use your own cash. If you want to use your own cash instead of a loan, that's fine. But obviously, you need to replace the value of that debt. So the key to remember here, equal or greater to what you sell the property for, and use all the cash. As long as you're doing that, you are deferring all your taxes. Now, one thing I do want to point out here real quick as we're wrapping up, You don't necessarily do an exchange just to defer taxes. The reason you do an exchange is because you want to buy something better. Now, what does better mean? Better means whatever the heck you want it to be. It could be I want something that gives me more cash flow. It could be I'm moving to Arizona, so I'm moving my rentals to Arizona. It could be I want something easier to manage because I'm retired and I don't want to worry about it. Maybe you want to sell 3 houses to buy a shopping center. Maybe you want to sell a shopping center to buy 3 houses. It all depends on what you want to do. What is a better property for you tomorrow than what you own today? 1031 is the tool that allows you to get from what you own today to what you want to own tomorrow. And if any of you have owned a rental property more than 10 years, my bet is you probably are sick of it. You probably would like something different. 1031 is the way to get from what you own today to what you want to own tomorrow. And with that, if you have any questions, I have my brochures and cards in the back. Yes?
You said it should be later or before, yeah.